Bank reconciliation is a vital tool for keeping a company's cash under control. Even though both the company and the bank track cash balances, their records often don't match due to timing differences or errors. For example, a company might record a sale as soon as it happens, but the bank won't reflect it until the deposit is made. Mistakes can also occur, either accidentally, like misrecording amounts, or intentionally, as in cases of theft. That's why reconciling these records regularly is essential. Let's look at Starlight Productions' own records for March 2024. Here, we see all cash received, like sales on different dates, and all payments made for expenses such as salaries, rent, and supplies. At the end of the month, after totaling up $35,900 in receipts and subtracting $24,900 in disbursements from the beginning balance, Starlight's books show an ending cash balance of $34,600. This is the number the company expects to see reflected by the bank. Now let's compare this to the bank statement from First Bank for March. The bank's ending cash balance for Starlight Productions is $26,400, not $34,600 as shown in the company records. Why the difference? To find out, we need to reconcile by looking for timing differences, like deposits or withdrawals recorded by one party but not the other, and checking for any errors. Only then can we be sure every cash transaction has been properly accounted for. A common mistake when reading bank statements comes down to terminology. On a bank statement, a deposit is called a credit and a withdrawal is a debit. But in financial accounting, it's the opposite. A debit increases cash and a credit decreases it. This difference comes from perspective. Banks see your deposit as their liability, so they credit it. Companies see it as their asset and debit it. Always remember which viewpoint you're working from. The journey of bank reconciliation has 3 key steps. First, reconcile the bank's cash balance by identifying items the company knows about but the bank doesn't yet. Next, reconcile the company's cash balance by spotting transactions the bank has recorded that aren't yet in the company's books. Finally, update the company's records to reflect any adjustments discovered along the way. Following these steps ensures accuracy and keeps your cash account reliable. Step 1 is all about the bank side. Start by identifying deposits outstanding. These are amounts received and recorded by the company but not yet processed by the bank. Also check for checks outstanding, which are checks written by the company that haven't cleared at the bank yet. Finally, keep an eye out for any bank errors that may have affected your balance. Pinpointing these items brings you closer to a true reconciled figure. In Step 2, focus on what the bank has recorded that hasn't reached your company records yet. This includes collections made by the bank on your behalf or interest earned. Both increase your cash balance but may not be known until you see your statement. Watch for items that decrease your balance too, like electronic fund transfers, non-sufficient funds checks, debit card purchases, service fees, and any errors made by your team. Correcting these ensures accuracy. Here's where timing differences come into play. By comparing Starlight Productions' cash receipts to what appears on the bank statement, we spot deposits that are in company records but not yet listed by the bank, like an $8,500 sale still outstanding at month's end. These are called deposits outstanding, and they cause the bank's reported balance to be lower than what Starlight records. Only unmatched items need further attention during reconciliation. Now let's examine payments. Comparing Starlight's records with the bank statement reveals 2 key issues. Check number 295 for $5,400 is still outstanding. It's in Starlight's books but hasn't cleared at the bank yet. Also, there's a $300 error where a debit card purchase was recorded as $3,000 instead of $3,300. These discrepancies highlight why careful comparison is so important. Each difference must be identified and adjusted to complete an accurate reconciliation. Let's walk through the bank reconciliation for Starlight Productions as of March 31, 2024. We start by adjusting the bank's cash balance, add deposits outstanding, and subtract checks outstanding to reach a reconciled bank balance of $29,500. Then, we move to the company's records, adding notes and interest received, and subtracting items like electronic fund transfers, NSF checks, service fees, and correcting errors. Both sides are updated until their reconciled balances match, confirming accuracy in Starlight's cash management. A common mistake students make is confusing an NSF check from a customer with a check written by the company itself. An NSF check means a customer's payment bounced due to insufficient funds. The company must then reduce its cash balance to reverse the deposit it had recorded. Until the customer pays up, this bounced check is treated as an account receivable. Recognizing this distinction helps prevent errors in your reconciliation process. Let's check your understanding of the bank reconciliation process with a quick concept check. When you're looking at the bank side or the left-hand side of a bank reconciliation, which items should you include? The answer is deposits outstanding, checks outstanding, and any bank errors. These are the timing differences and mistakes that affect the bank's records but haven't yet been reflected in the company's books. Other items like interest income, NSF checks from customers, and service fees are handled on the company's side. Remember, knowing which adjustments belong to which side is crucial for an accurate reconciliation and helps prevent common student errors. How do we treat an NSF check from a customer during reconciliation? It's shown as a deduction on the company's side. When the company first deposits a customer's check, cash goes up. But if it bounces, we must reverse that increase, so we deduct the amount from the company's cash balance. This ensures our records match what actually happened in the bank account. After reconciling, it's time to update the company's cash account. For every item that adds to cash, like interest or note collections, we debit cash. For those that subtract, such as EFT payments, NSF checks, or service fees, we credit cash. These adjustments ensure our books reflect all new information discovered during reconciliation. The offsetting entry depends on each specific item. What happens if, after all your careful adjustments, the bank and company balances at the end of your reconciliation schedule still don't match? Management must investigate the discrepancy to determine if it's due to an error or even possible wrongdoing by employees or the bank. If the difference can't be resolved, the company records it as either miscellaneous expense or miscellaneous revenue, depending on whether the balance is a debit or credit. For example, if $100 is missing and can't be explained, you would debit miscellaneous expense and credit cash for $100. This step ensures that your financial records remain accurate and transparent, even when small discrepancies persist. A frequent mistake students make during bank reconciliation is trying to update the company's cash account for deposits outstanding, checks outstanding, or bank errors. However, these items are already properly recorded in the company's accounting records, so no further adjustment is needed on the company's side. These adjustments are only necessary for the bank's balance, not the company's. Focusing your efforts on the correct side of the reconciliation helps you avoid double counting and keeps your records accurate. Remember, understanding which items require adjustments and which do not is essential for mastering the bank reconciliation process and ensuring your financial statements are reliable. Let's summarize the key items included in a bank reconciliation. On the bank side, you start with the balance per bank statement, then adjust for timing differences like deposits outstanding and checks outstanding, and finally, account for any bank errors. On the company's side, begin with the general ledger balance, add notes and interest received by the bank, and subtract unrecorded payments, NSF checks from customers, and bank service fees. Both sides also require adjustments for errors, bank errors on the bank side and company errors on the company's side. The goal is for both reconciled balances to match, confirming your records are accurate. The key point in bank reconciliation is simple. Adjust the bank's cash balance for transactions not yet recorded by the bank and for any bank errors. Do the same for the company. Consider transactions not yet in its records and any company errors. After all adjustments, both balances should match. Record any necessary changes to keep your accounts up to date. When you discover an NSF check from a customer, it's important to record it correctly in your accounting records. The proper entry is to debit accounts receivable, which increases the amount the customer owes, and credit cash, which reduces your cash balance. This adjustment reverses the increase in cash you recorded when the check was first deposited, since the funds were never actually received. By debiting accounts receivable, you acknowledge that the customer still owes you money, and by crediting cash, you ensure your records reflect the true cash position. This careful attention to detail is essential for maintaining accurate and reliable financial statements.